Hi, I am Rhea Baid, working as a research associate with Mirae Asset Capital Market India. We are currently covering IT and internet companies that are listed on the Indian stock exchanges. In terms of a brief industry overview, the revenue of the Indian IT industry stands at $245 billion as of March 2023. With exports accounting to $195 billion, the Indian IT industry constitutes of IT services, BPO, ER&D, software products and hardware. According to NASSCOM, the Indian IT BPM industry is estimated to reach $500 billion by FY30 from current revenue of $245 billion, implying a CAGR of 10 to 11%. The key issues of the sector, if I were to say, the tech spends of large industries slowed down significantly in CY23, which has resulted in a moderation of growth for IT firms. We are estimating the revenue growth for IT services companies to be in the range of -6 to 6% for FY24, compared to a revenue growth of 8 to 12% in FY23. The major issues that are impacting the growth, if I were to spell them out, the Indian IT firms are macro factors which include high inflation and geopolitical issues, normalization of excessive spendings driven by pandemic-led digital activities, reduced outsourcing to utilize the in-house talents which were previously hired, broad-based weakness in demand across verticals, but especially in banking, retail and telecom, and a reduction in discretionary spending. The growth in FY24 has been impacted by normalization of excess technology spending for digital journeys by enterprises post the pandemic. With the emergence of challenging macro environment and geopolitical issues, enterprises have started focusing on cost. As a result, organizations have cancelled or paused their projects with no near-term ROIs. Increasing focus on costs and elevated inflationary environment has shifted client focus towards optimizing expenses and rationalizing discretionary spending and delaying the decision-making process. Such activities have impacted the IT services spendings for service providers. In addition, select large financial firms are utilizing in-house talent for small cycle projects, leading to a reduction in outsourcing activities. However, we are confident in the revival of growth for Indian IT services firms in the medium to long term, given their strong competencies, a large talent pool, and a long-standing relationship with clients. Stabilization of the macro environment, revival of discretionary spending in CY24 are expected to accelerate the growth of Indian IT industry in the next fiscal year. So in terms of the risk factors and investment strategies, we believe that IT spending will recover in CY24, driven by stability in economic situations, recovery in discretionary spending, and pickup in investments in digital transformation initiatives. The macro outlook in the US is incrementally improving with the reduction in the inflation rate and nearing the end of Fed rates hike cycle. Additionally, lowering of discretionary spending is bottoming out in certain segments. We believe that enterprises will gradually start resuming their digital journeys that were paused in the midway, which will accelerate the growth in FY25. Further, the anticipated recovery in discretionary spending and ramp-up of large deals will aid to the growth in FY25. The growth of Indian IT will depend on certain factors. One would be the growth in technology spending, two, market share gains. The long-term IT services spending growth has been significantly outpacing the global GDP growth. On the other hand, Indian IT is well poised to continue to gain market share on the back of large labor arbitrage, global delivery model, large talent pool, prudent investments in technologies, and long-standing relationships with large enterprises. We continue to believe that the Indian IT will continue to gain market share given the lack of global diversified quality IT vendors, the shift towards an outsourcing model, and the availability of a large talent pool. Nifty IT index has outperformed the broader markets by 130 bips over the last 20 years with a CAGR growth of 14.4%. The sector has performed relatively well because of its defensive categories, currency depreciation, acceleration in demand, and stable margins. Thank you so much.